This is Ginza, one of the districts in Tokyo in 1945 after the area was devastated by air raids. Here is the same place at night in the late 1990s following the nation's experience with a bubble economy. And this is in 2020 when COVID-19 spread throughout Japan and fewer people ventured outdoors. These three pictures capture the ebbs and flows of the Japanese economy since 1945. This nation's economy, within a century, has resurrected from war's aftermath, reached economic pinnacles, faced severe downturns, and adjusted to global changes. After World War II, under US government supervision, Japan reconstructed and skyrocketed economically, leading to the Japanese economic miracle. However, this trajectory wasn't free from pitfalls, as the 1980s bubble economy culminated in the last decade. The contemporary phase introduced its own set of trials and innovations, with policies like Abenomics under Prime Minister Abe, and later, strategies for handling the repercussions of a pandemic. Hi, my name is Atsu, the owner of this channel, and today we explore the highs and lows of Japan's economic chronicle, illuminating its historic influence on present-day challenges. The war left Japan in ruins, with destroyed infrastructure, paralyzed industries, and a significant portion of its population homeless. However, under the watchful eye of the US-occupied forces, and with the help of strategic policies, Japan experienced a transformation known as the Japanese economic miracle. In the immediate aftermath of the war, Japan came under the administration of the Allied forces led by the United States during a period referred to as the Occupation. General Douglas MacArthur, appointed as the Supreme Commander of the Allied Powers, SCAP, was responsible for overseeing the country's reconstruction. SCAP implemented several policies to democratize and demilitarize Japan. These efforts included enacting a new constitution in 1947 known as the Post-War Constitution or Constitution of Japan, which limited the emperor's power and prohibited Japan from having a military. Drastic economic reforms were also introduced during this time. In 1949, these reforms took the form of the Deutschline, a policy set by Detroit banker Joseph Dodge, who was then serving as a financial advisor to Japan. By cutting government spending, the Deutschline policy sought to control inflation and stabilize the economy. Additional policies were introduced, such as land reforms, aimed at reducing the power of the landlord class by distributing land to tenant farmers. This move significantly boosted agricultural productivity, ensured food security, and paved the way for the industrial development. Industrial reforms aimed at dismantling the zaibatsu, powerful family-controlled conglomerates, were also put in place to encourage free competition. A notable example was Mitsubishi, a conglomerate that had dominated markets such as ships, railways, and mining industries. These reforms, however, were later laxed due to the fearsome spread of communism during the Cold War. By the early 1950s, Japan's economic turnaround began to take shape, significantly catalyzed by the Korean War. Japan's role as a supply base for US and UN forces increased the demand for the Japanese goods, sparking the growth of the industrial sector. This period, known as the Special Procurement Boom, marked the beginning of the rapid economic growth. The Japanese government also introduced policies that promoted industrialization and export-led growth. The government cooperated with the private sector in a pattern often referred to as Japan Inc. Industries such as steel, shipbuilding, electronics, and automobiles were prioritized and given state support. This was accomplished through subsidies, tax incentives, and protective measures against foreign competition. Japan's new education system, based on the American model, played a vital role in fostering democratic ideals and scientific thinking. The system emphasized science and engineering education to support industrial development and implemented a 6-3-3-4 structure, which signifies 6 years of elementary, 3 years of lower secondary, 3 years of upper secondary, and 4 years of university. Additionally, the education was made mandatory up to the age of 15. This approach resulted in a well-educated and highly skilled workforce that could adapt to the demands of a rapidly industrializing economy. The traditional Japanese cultural values of hard work, discipline, perseverance, and group harmony further cultivated a strong work ethic and cooperative spirit. These values became instrumental in driving high levels of productivity and innovation, thereby becoming a cornerstone of Japan's post-war economic success. As the 1950s drew to a close, the foundations of Japan's rapid economic transformations were firmly in place, setting the stage for an era of unparalleled growth and innovation. Government-driven policies, a rejuvenated education system, and the burgeoning industrial sector converged, preparing the nation into an age of economic prosperity. This golden period, which extended from after the war to the early 1970s, solidified Japan's position as an economic powerhouse on the global stage. From 1953 through October 1973, Japan's economy grew at an unprecedented average rate of 9.2% per year. Manufacturing, especially in the auto and electronic sectors, became the linchpin of the Japanese economy. With government initiatives and protectionist policies that favored investment in these sectors, Japanese giants such as Sony, Toyota, and Honda evolved into multicultural corporations. This epoch is consistently referred to as a Japanese economic miracle, symbolizing the time when Japan burgeoned as a dominant global economic and industrial force. A cornerstone of this growth was Ministry of International Trade and Industry. It provided oversight and steered Japan's industrial policy, directed investment, nurtured nascent industries, and championed large-scale industrial projects. Intertwined with its policy-guided growth was Japan's unique corporate culture, characterized by lifetime employment, seniority-based advancement, and unwavering company loyalty, all contributing significantly to the nation's industrial accomplishments. Beyond industrial policy and corporate culture, economic and financial structures were pivotal to the Japanese economic miracle. Post-war reforms galvanized the Japanese public into saving their income, allowing banks to channel these funds into industries. Concurrently, due to the peace constitution, Japan's defense expenditure remained restrained, which redirected more resources towards economic expansion. Events like Tokyo Olympics in 1964 and the World Exposition in Osaka in 1970 not only showcased Japan's resurgence on the global stage, but also bolstered domestic confidence and international investment. However, despite this success, the durability of the Japanese economic miracle was tested.
The Middle East war produced developments all over the world today. The oil-producing countries of the Arab world decided to use their oil as a political weapon. They will reduce oil production by 5% a month until the Israelis withdraw from occupied territories.
In October 1973, the Organization of Arab Petroleum Exporting Countries, WWII, announced an oil embargo in retaliation to Western backing for Israel during the Yom Kippur War. This instigated the first oil shock, manifesting in skyrocketing oil prices and ushering in the world energy predicament. The ramifications for Japan, a nation predominantly dependent on oil imports, were profound. The cost of oil quadrupled, igniting inflation, dwindling economic growth, and thrusting the country into recession. This marked the culmination of the high-growth phase of the Japanese economic miracle. However, this adversity also compelled Japan to diversify its energy portfolio and enhance energy efficiency. Investments swelled in avenues like nuclear power, natural gas, coal, and renewable energy. This shift, combined with the advancement of energy-efficient technologies, not only helped Japan to navigate the immediate crisis, but fortified its global industrial competitiveness for the future. Despite the setback caused by the 1973 oil crisis, Japan's economy proved resilient. In the years following the end of the Japanese economic miracle in October 1973, Japan navigated the crisis through an emphasis on energy diversification and efficiency, maintaining robust, albeit slower economic growth. However, by 1985, a new chapter in Japan's economic history was set to unfold, marking the beginning of an era known as the bubble economy. The genesis of the bubble economy can be traced back to the Plaza Accord signed in 1985 at the Plaza Hotel in New York. This agreement between major industrial countries aimed to depreciate the US dollar against the yen and the German mark. The subsequent rise of yen made Japan's export more expensive, threatening its economy, which had been heavily reliant on export-led growth. In response, the Bank of Japan (BOJ) implemented an easy monetary policy, cutting interest rates drastically. These lower rates led to increased borrowing and fueled a surge in corporate and individual investments in real estate and the stock market. Fueled by the availability of easy money and driven by a widespread belief that asset prices would continue to rise indefinitely, a frenzy of speculative investments took hold. Land and stock prices soared far beyond their intrinsic values. At the height of the bubble, the grounds of the Imperial Palace in Tokyo were reportedly valued more than all the real estate in California. The booming economy and skyrocketing asset prices fostered a sense of invincibility in Japan. The nation seemed poised to overtake the United States as the world's largest economy. Japanese companies, riding high on these inflated valuations, embarked on ambitious foreign acquisition, including notable assets such as Rockefeller Center in New York and Universal Studios in Hollywood. However, the bubble's burst was inevitable. The BOJ, alarmed by the overheated economy, began to hike interest rates in 1989. The increase in loan costs led to defaults, triggering a catastrophic collapse in asset prices. By 1992, many of the land prices in Japan had dramatically fallen. This marked the onset of Japan's lost decade. The fallout from the bubble bursting was devastating. Banks and financial institutions were left burdened with huge amounts of bad debt as borrowers defaulted on their loans. The Japanese government's initial response, focused on rescuing the banking sector, was often criticized for being slow and inadequate, exacerbating the crisis and contributing to its prolongation. It wasn't until the late 1990s that substantial steps were taken to address the bad loan problem, including financial injections into the banking sector to supervise a reconstruction of the financial system. Compounding the financial and economic issues was a notable demographic shift. As the number of elderly citizens increased, the working-age population, those capable of active employment and contributing to economic production, began to decline. This demographic shift presented a significant challenge. Fewer workers led to reduced consumption, less investment, and ultimately lower economic output. This intensified economic difficulties that had arisen from the burst of the bubble. In response, the Japanese government implemented measures to restructure the economy, improve the health of the banking sector, and combat deflation. An example of this is the establishment of the Innovation Network Corporation of Japan in 2009, a public-private partnership aimed at promoting innovation and enhancing the value of businesses in Japan. Despite these efforts, Japan's GDP growth has remained relatively slow compared to other nations. By the point of 2023, the nation has yet to return to the high growth rates of the pre-1991 period. While it remains the third largest economy in the world, the last decade and its aftermath have left a profound mark on Japan's economic trajectory, including a persistent pattern of slower GDP growth. As Japan entered the 21st century, the repercussions of the lost decade were still palpable, with persistently low growth and deflation hindering recovery. Despite attempts to reform the economy and stimulate growth, Japan's economic stagnation remained a challenge. It was in this context that in 2012, Prime Minister Shinzo Abe launched an ambitious economic revival plan known as Abenomics in an attempt to break away from the long-standing economic issues. Abenomics, named after Japan's Prime Minister himself at that time, was an economic policy implemented from 2012 to 2020 in an attempt to revive the stagnant Japanese economy. Abenomics encompassed three arrows: bold monetary policy, flexible fiscal policy, and a growth strategy promoting private sector investment. The first arrow, bold monetary policy, saw the Bank of Japan (BOJ) taking aggressive steps to break Japan's deflationary spiral. This included expanding the monetary base and setting a 2% inflation target. The idea was to inspire inflation expectations, which would ideally encourage spending and investment, as consumers and businesses anticipate higher prices in the future. The second arrow, flexible fiscal policy, entailed increased government spending in the short term to stimulate demand, combined with longer-term commitment to fiscal consolidation. A significant part of the strategy was controversial decision to raise the consumption tax from 5% to 8% in 2014 and then to 10% in 2019. The third arrow, a growth strategy to stimulate private investment, involved various structural reforms aiming to increase the competitiveness of Japanese companies. These included reforms of labor market and corporate governance and measures to stimulate innovation and entrepreneurship. There are several positive aspects of Abenomics. Firstly, the aggressive monetary policy helped to combat deflation, which has plagued Japan for years. As I mentioned previously, prior to Abenomics, Japan was stuck in a persistent deflationary spiral. Inflation in Japan has been low since the early 1990s when the bubble economy came to an end. However, it exceeded more than 2.5% for the first time in 2014, 2 years after Abenomics was implemented. It brought about mild inflation, helping to reduce the real burden of Japan's substantial public debt. Moreover, the weaker yen, a side effect of this policy, boosted exports, providing a stimulus to Japan's export-oriented economy. Additionally, the fiscal stimulus helped to support demand in the short term, aiding in reviving the economy from its extended stagnation. The structural reforms, though slow to show results, hold promise for improving Japan's long-term growth potential. However, Abenomics also faced several challenges. One is the rise in the consumption tax. The first significant challenge with the consumption tax rise was its timing. It initially increased from 5% to 8% in 2014, at a time when Japan's economic recovery was still fragile. This tax hike corresponded with a contraction in consumer spending, potentially contributing to a recession. The tax increase reduced consumer purchasing power, which had potential implications on household spending, a key driver of economic growth. In addition, Japan has its demographic issues. With a rapidly aging population and shrinking workforce, Japan faces a significant challenge in boosting domestic consumption. Raising the consumption tax further discouraged consumer spending, particularly among older citizens with fixed incomes. While the consumption tax raise aimed to address long-term fiscal sustainability, its negative impact on consumption underscored the difficulty of managing this delicate balance. Another criticism is that Abenomics heavily rely on the first arrow, while progress on the third arrow of the structural reforms was relatively slow. One of the major reasons is that implementing monetary policy changes is relatively straightforward in that they can be enacted by central bank. These changes do not require widespread legislative change or the overcoming of significant vested interests. Structural reforms, on the contrary, often require broad legislative changes and can encounter significant opposition from various sectors of the economy that prefer the status quo. Additionally, while the effects of the monetary policy can be seen relatively quickly, like in the form of inflation rates, currency exchange rates, etc., the benefits of structural reforms often take longer to materialize. Due to several factors, some observers note that focus of Abenomics was heavily skewed towards monetary policy. They also argue that there was not enough progress on the critical structural reforms necessary for Japan's long-term economic health. As Abenomics ended with Prime Minister Shinzo Abe's resignation in 2020, Japan faced a daunting task of navigating an uncertain economic future. The three arrows of Abenomics had produced mixed results, combating deflation and instituting important structural reforms, but also leaving Japan with considerable public debt. The subsequent leadership would not only grapple with the legacies and unfinished business of Abenomics, but also confront the unprecedented economic challenges brought on by the COVID-19 pandemic. The post-Abenomics era in Japan, led by Prime Minister Yoshihide Suga and Fumio Kishida, was met with a mixed economic climate. As the country adjusted to new leadership following the end of Prime Minister Shinzo Abe's reign, they had to navigate not only economic policies and reforms that were initiated under Abe, but also far-reaching effects of the COVID-19 pandemic. Japan, like many other nations, was severely affected by the pandemic. As a country heavily reliant on both domestic and international tourism, the sudden halt of global travel and public health concerns severely impacted the economy. Many small and medium-sized enterprises, the backbone of the Japanese economy, were forced to shut down, and the government had to initiate significant stimulus packages to prevent a total economic collapse. Under the post-Abenomics leadership, the government had to make significant adjustments to manage economic fallout from the pandemic. While monetary and fiscal policies continue to be used as a tool to stimulate the economy, the government placed an increased emphasis on digital transformation and green initiatives, both of which are seen as new drivers of economic growth. In terms of digital transformation, post-Abenomics leadership formed a digital agency to accelerate Japan's digitalization, lagging despite its technological progress. The agency aims to streamline government services, boost cybersecurity, and promote digital innovations like online education and telehealth. This digital acceleration could stimulate economic growth by reducing administrative inefficiencies, fostering tech innovation, increasing productivity, and enhancing Japan's international digital competitiveness. Regarding green society vision, Japan rolled out a green growth strategy under Post-Abenomics leadership, pledging to be carbon neutral by 2050. This strategy necessitates transitioning from fossil fuels to renewable energy, promoting green industrial innovation, and shifting to electric vehicles. Despite potential short-term economic disruptions, this green transition opens up opportunities for investment in sustainable industries and positions Japan as a global green economy leader. Meanwhile, from the latter half of 2021, the economy saw a partial rebound as restrictions eased and vaccine distribution progressed. But the pace of recovery remained slow and fragile. On the international front, COVID-19 also redefined Japan's economic and political relationships. China remained a crucial trading partner, but as their factories closed in an attempt to control the virus spread, the logistics were affected. Because of this, Japan faced significant supply chain disruptions, and this led to a re-evaluation of the nation's economic dependence on China. In response, the Japanese government initiated a strategic rebalancing, aiming for greater supply chain diversification. This involved incentivizing Japanese companies to reduce their dependence on China and expand into other regions like Southeast Asia, where labor costs were low and there is a growing consumer market. Simultaneously, Japan sought to strengthen its economic ties with more stable economies like the US and Europe. These efforts were intended to make Japan's economy more resilient to future shocks. The post-Abenomics era in Japan, significantly shaped by the COVID-19 pandemic, saw an extension of Abe's policies with added layers of complexity. These included greater emphasis on digital transformation, green initiatives, healthcare reforms, and international diversification, all the while trying to stabilize the economy amid the challenges of the pandemic. The effectiveness of these new directions, however, remained to be fully seen and would define Japan's economy in the years ahead. I personally think that the Japanese economy's trajectory is marked by resilience and adaptability, which mirrors its nation's spirit. From post-war ashes, Japan, fueled by astute policy decisions and an indomitable workforce, ascended to global economic prominence. This journey, however, was not devoid of pitfalls. It encountered oil shocks, financial bubbles, and the unprecedented challenges of the 21st century, including the enduring scars of the last decade and the uncertainties of the COVID-19 era. Yet, each downturn was met with innovation, from energy diversification in the 70s to digital and green aspirations of recent years. Today, as Japan strives for carbon neutrality and digital progress while recalibrating its global economic ties, it remains an embodiment of perseverance and innovation. The rises and falls of its economy serve not as a cautionary tale, but as testament to the enduring spirit of a nation that refuses to be defined by its setbacks.